All right, investors, this is going to be an absolute banger of a video. I'm going to talk about JD. It's in the buy zone again, okay? It's back at prices that it's been at in 2015 with a revenue that's like 6 times higher. So we're going to do a lot of deep dive here into JD to try to figure out if it's a buy, and I'm going to give you a conclusion and what I'm doing about it at the end of the video. Now, first of all, JD is an ADR, an American Depository Receipt, of a VIE, a variable interest entity, that is positioned in the Cayman Islands. And the way it works is that entity more or less has trade agreements with the Chinese company based in China for the rights of the profits of that company, which is one of the reasons why they don't dish out too much profit, I think. But that's besides the point. The structure of this company is actually pretty complicated. If you pull up the 20F, and the 20F basically is an annual report that foreign companies listed in the United States must file in order to be legally traded in the US stock exchanges. So if you look at their 20F, you can figure out by yourself, if you're brave enough, what this structure actually looks like here. So above the little broken line is the offshore entities, and below the line is the onshore entities. And, they interact in a very interesting way, very complicated way, I might add, in order to make it legal per the country's laws for foreigners to own any kind of participation, right, in Chinese companies. Because in China, it's illegal for foreigners to own direct ownership in the companies. But I think they're okay if foreigners own the profits for those companies, as long as they don't have operating shares. Mainly, what mainland it cares about is control. They don't want foreigners controlling their own companies. So in the United States, we don't have those rules. Europe, right? Anyone around the world can buy controlling shares of the company. Usually that's not too big of an issue because most of the wealth is concentrated in the United States and Europe anyways. And so the controlling parties end up being, from Europe or in the United States anyways. However, since China is trying to go and grab capital from the rest of the world to invest in their own country, those rules kind of, I guess, make more sense for them. It would probably be a different story in the West if, people from other countries started like having majority voting shares in U.S. companies and started controlling them around and do their bidding, right? It would be a little bit of it would not be good for local citizens, and these rules might be erected. So no judgment there. They got to do what's best for their country. That's fine. But this is basically a way to get around the structure, and it's worked out for everyone so far. And the structure is holding. It's been around for, 15, 20 years or something like that. Maybe more. I think maybe since 2000. Somewhere around the 2000 area, plus or minus 5 years. Don't quote me. So it's been holding so far. It's had a few close calls where they almost did away with it. They've had, all kinds of reviews, and the regulators vowing to make things work with the United States regulators, the PBAOC and whatnot, and this whole drama that's been going on. Like, I don't want to go through that. This video is not so much about that. The point is that the structure is still standing. You can still trade JD and Alibaba and other entities, even some over-the-counter like Tencent. You can still trade them in the United States, and that's fine. So besides this complicated structure, a little overview of JD. This is the website. If you type jd.com, I'm still on the overview, guys. I'm sorry, okay? Still on overview here. The agenda is on the bottom right corner of your screen. So the website, it says here, if you type jd.com, it kicks you to corporate.jd.com/home in the United States. It says some quick statistics about the company. The orders placed through the mobile platforms are 90+%. So, they're not too heavy on the physical stores there. They have 30 million, I think this is 30 miles, squared miles, 30 million square miles? I have no idea what this means. Or maybe 30 million square meters. Oh, that makes more sense. Warehouse network. They have over 1,500 warehouses, and their net revenue. Well, wouldn't that be crazy? 30 million square miles. Anyways, so net revenues for 2022 was 151 billion. Oh, by the way, quick intermission. There's no edits here, right? So there's gonna be some stumbling and whatnot. So just relax, grab a drink, chill, just have a conversation here. I don't got time to edit all this, so we're gonna do one straight shot, and hopefully it's a one take Drake type of scenario here. 151 billion. I'm gonna come back to this number here in net revenues for 2022. So that's a quick overview here of the numbers. Next, I'm going to go into finances. All right, so I'm going to use stockanalysis.com, and which is a free resource. I'm not affiliated with anyone. And we're going to look at the stock price first, because stock price is something amazing to be had here, to behold. So 33.7 is the current quoted price at April 26, 2023, which is when I'm making this video at midnight. So in the beginning of the day. And the price of per share is 33.7, which was at a similar price all the way back in 2015, right here. Look at this, 2015, April 27, basically the same price. Same price. And look what the company's done ever since. We're going to go to annual. I usually like to quarterly for more definitions, but I want to extend the bars here. Look at what's going on here. 2015, how many? This is, by the way, in yuan or RMB or renminbi. Chinese have like this dual currency system. I'm still not even clear on how it works, the interplay between them. But anyways, let's just call it yuan for right now. So they have 181 billion yuan and in 2015 revenue, and now in 2022 it's over $1 trillion. So that's quite the advance. I mean, this company has exceeded expectations. Look at this real revenue growth year over year: 65%, 57%, 42, 40, 27, 24, 29 in 2020. 27, and then 10% in 2022, which is still good, by the way, because 2022, remember what happened to most companies? Crazy town. Okay? Craziness going on here. So, that's the revenue growth. Unbelievable. Now, one of the reasons why, I don't want to go too speculative, so I'm not going to talk about net income too much, but from my perspective, they are really doing a lot of massaging from the revenue side. I believe that they can consistently get revenue out, but they're doing what's optimal for many reasons. Number one, probably because the government will look badly on, this is pure speculation, but on money leaving mainland, right, to go into the investors. So they don't want them paying out too much dividends or buying back too many shares or whatnot. They want them to have zero profit to service the country, right? All for one for all type of deal. So they don't want money leaving, and they don't want to have these huge profits because they're already getting slammed by regulators. In fact, that's been the story for all these ADRs and ADR-VEs from China ever since the hammer was first dropped in the beginning of 2021. As you can see, JD's experienced a steady decline. It's been the drum roll of the Chinese regulators cracking down, that's their term there, on their companies, on their own tech companies, because they don't want them to have too much control over the populace, over the economy, over everything that's going on in China. The whole like Jack Ma populism thing that he got shut down. Now he's just relegated to playing golf 24/7 and doing things internationally under not too much spotlight, and that's intentional. So there's a bit of a power struggle apparently in China, and Xi obviously won. But I'm not even going. I don't even want to get into like the whole political thing, because everybody's going to jump in with their opinion and be like, no, nothing was going on, blah blah blah, this and that. I'm not. This is not what this video is all about. I just want to look at the company. We're going to talk about the risks in a minute at the end of the video. Okay, so but for right now, let's stick to finances, and then now we're going to go into a little bit of valuation talk plus the finances. If we click on the statistics here, you'll see that the enterprise value of the company is only 30 billion. Market cap is 53, which tells us that, you know, they have about, what is that, 23 billion in cash. If we scroll down into net cash, you'll see that they have 23.12 billion. I believe these are in dollars. I believe these are in dollar amounts. So, I mean, obviously, yeah, they have to be in dollars. Balance sheet, cash equivalents, yeah, definitely, because cash equivalents 226 billion versus total debt of 65 billion, and if you subtract those two, you get the net, you know, cash amount. So 23 billion in cash on a company that's market cap 53 billion. So the enterprise value, the cost of the actual business out, you know, except the cash, is $30 billion, which is very cheap for a company with $151 billion in revenue. So let's start to figure out like how underpriced this company is. So just to reiterate here, sorry, I had my face showing. 30 billion, 53 billion market cap. I was showing you the finances. We'll look at them again here. Under balance sheet, 226 billion yuan, and total debt 65 billion. You subtract the two, convert to currency, and you get 23 billion. Statistics. Valuation ratios. Look at this. PS ratio 0.35. PS ratio is price to sales ratio. Price to free cash flow 9.72. 9.72. Look at this forward PS. I don't even think this is real, but it's 0.05. Like, I don't know how they get that. But what's even more impressive than than these metrics is if we scroll down and look at the enterprise valuation metrics. There, even the little bit of 10 billion that they made this last quarter or something like that, I don't know how much they made last year, but their earnings, EV to earnings ratio is 20, which is really, really good. This is like value territory for such a fast growing company. It's incredible. EV to sales is 0.2. What? 0.2 enterprise value to sales. Ridiculous. Incredible. EV to free cash flow is 5.48. Unreal metrics over here. For a company like this that's growing, even now, even through 2021, 22, you saw how the revenue was growing and everything was growing. If you look at the overview, look what the stock price was doing. While in these 2 years, since the beginning of 2021, these 2+ years, the revenue has been on track growing, while the stock price is 1/3 of where it peaked at back in February of 2021. 1/3, while the revenue is up 1/3. So is the price reduced by 2/3 while the revenue is up 1/3, which is craziness, absolute craziness. So the valuation now is cheapest as it's ever been, basically, cheapest as it's ever been. As far as dividends, they don't pay. They just paid like a one-time dividend. Here's something that maybe people can look at as a negative: is this profit margin here of 0.99. So profit margin is the margin after all the other margins, right? Starts with gross margin, operating margin, pre-tax profit margin. So this is what is basically determining how much of the revenue actually turns out to be clear profit that can be used later by the company or dispersed back to investors. So the percentage is very low, but the thing is, this company can't increase it. They just choose not to. They choose not to in order to keep the growth of the company and to keep stealing more market share or competing for more market share. I gotta watch my word choices out here. In the industry. Now, speaking of industry, there were a couple of interesting things that happened that I found in the 20F outside of this little graph of corporate structure. And I don't know if I can look through them right now, but basically, there was a graph of the share of the type of business that they do. And it looks like, I probably won't find it. There's so much. This is 285 pages. 285 pages. I mean, I skimmed through all of it and tried to look for something interesting. But who's going to be looking through 300 pages worth of like text and numbers, man? This is ridiculous. Who's got time to read all this? But anyways, it had the businesses broken down by categories. Well, I can't find it right now. It's too much to list through. But what struck me is that the logistics services part is the one that's been growing as a market, as a proportion of their overall business. And their most dominant source of revenue is just basically household and electronic goods. And that's been shrinking as a percentage of their total base, not in total value, but just as a percentage of what their share of the revenue is. So I found that interesting. This is a trend that's been happening over the last 4 years or so. So it's probably worth noting. But moving on from the 20F, what I want to do next is I want to compare it to Walmart. Now, why Walmart? Well, maybe to Amazon, but Amazon is even worse. But I just want to take, the reason I want to take Walmart is because it's a very established business. It's got, brick and mortar. It's got, it's probably the biggest employer. JD's a big employer as well. So it's got a lot more overhead. Perhaps its ability to run as efficiently as something like Amazon or some other retailer is a little bit handicapped. So I'm basically doing, a minimum comparison to, a business in the United States that doesn't have the risks that JD has, and it's valued normally, right? So I'm gonna go to Walmart, and I did some calculations here. The market cap of Walmart is $408 billion. Their enterprise value is 459, which tells me they're about 50 billion in debt. So that's already working against them, right? So let's just talk about enterprise value. It was 30 for JD, 459 for Walmart. Let's take revenue as a metric. Okay, the revenue of Walmart is 611. I did some quick math. The revenue is 151 for JD. So I divided it all up, and by revenue, JD is undervalued by 3.75 times. So the equivalent of Walmart today being worth somewhere around the $40 range, which they haven't been at that price since 1999. How many of you would like to buy a Walmart at $46 or something like that? $40 right now. Huge. Not to mention, by the way, that Walmart is really mature. I mean, it's growing in revenue slowly, mostly probably due to inflation. It's grown very slowly in revenue. It doesn't have the astronomical growth rates that JD.com has, right? 2.4%, 4.3, 0.5, 2.3, 8 point. This is the inflationary times here, inflationary quarters, 2022, early 2022. Right? Let's take a look at annually. Look at these growth rates annually. 3%, 3%, 2%, 7% in 2020, inflation. 2.5, 6.73. A lot less than JD, right? So the trend is JD is much more of a growth company. Can we agree on that? So there should be a premium on the company for that and not a 4x anti-premium. Cheapness premium. Devaluation by 4 times. Now, I wanted to bring that up because I just want to put in perspective like how much risk is being priced into the price of JD. And I'm sure Alibaba as well and other Chinese ADRs. So, which brings me into the risk part of this conversation. And yes, the risks are large. Okay, and we have to always ask ourselves, okay, to what extent am I willing to decrease the price of the stock based on these risks? So we have some very obvious risks, right? Delisting risk, right? We've heard about delisting risk for like, I don't know how many years, 5 years or more. Been battling with this delisting risk. We've heard, political risk, like, anti-trade, right? Anti-globalization, blah, blah, blah. Some companies have already started moving out of China, right? I mean, Apple famously is taking up ground in India, favoring India over China. So a lot of the corporations are moving operations there. Tesla's not. Tesla's doubling down on China. So it's a little bit, can be a little bit of a mixed bag. I think most companies are trying to retreat out due to the political climate. Then we have Taiwan. When I say Taiwan, I'm sure some of you could get like goosebumps, okay, because everybody's opinionated in one way or another about all these issues. The regulation issues, the Communist Party, Taiwan triggers everybody. But it doesn't matter what your opinion is, right? It matters that it's a risk, okay? And you can assign any value on that risk, okay? But at what point are you willing to treat JD as an option, right? At what point do you say, okay, this is so damn cheap that just buying like 100 shares is so much better than going out to a nice dinner with my friends, right? Just gonna skip on the dinner and just buy this option that doesn't have an expiration date, or maybe it does, but we just don't know when it is. If relationships sour between the U.S. and China, and instead of going out to that nice dinner, you buy a bunch of shares of JD. And if you want to leverage that bet, you can just buy some leaps of JD. I think the 2025 options are trading right now, so you can try to do that. I've done it before. I lost some money. I bought some leaps on JD, Alibaba as well. Lost some money, made some money, but the bottom line is, at some point, at this valuation, it's incredible how the company keeps growing and the price keeps dropping. So what I'm trying to do, okay, let me show you my public account. I have a public account. If you're stuck this far, you get to see it. I make video logs sometimes detailing what I'm doing with this account. Currently, the account looks like this. I have $36,000 in cash, earning interest, and I'm waiting basically for a crash of some sort so I can pick up some more shares. And then I have Apple, Realty Income, Main Street Capital, which are my main positions. And then I have this low position. It's my last position, which is only $1,000 right now. I've been trying to average down a little bit. Currently, I have a 34.29 average cost on these $1,000. And if JD keeps dropping, I'm thinking I might enter and buy more shares into this company in hopes that it will double or triple in the year or 2 or 3 ahead. So this is personally what I'm doing. I'm entering with small amounts. And if it dips down really aggressively, I'll probably buy the leaps. And that's what I'm doing myself. Now, for you, obviously, each individual is different. This is not financial advice. You have to do your own due diligence, consult with an investment investment professional if you're struggling, this and that. I'm just an individual investor just like you, and you're responsible for your own choices as an investor. So figure out what your risk tolerance is. The risks are many with this company, but at some point you gotta say like, okay, how low is too low? I mean, if JD was trading at $0.01 for trading a penny, and the risks of delisting and everything else were the same as they are now, wouldn't you just buy a bunch of it? I mean, the company's making 151 billion in net revenue in last year and growing, and has so much cash on its balance sheet. Like, you're basically literally getting, dollars on the penny, or actually more than dollars on the penny, getting like $50 on the penny if things don't blow up. So everything has a price on it. That's the way I look at every single asset in the markets out there. It's just what is the price that you're buying it. I mean, look, the risks are real. I lost on the Russian fiasco, right? I had some Russian stocks and they went kaboom because of the war, and now all those positions are zero. They're zeroed out. So it's a real risk. But at some point, if you're willing to lose the money, if you're not willing to lose money, you shouldn't be trading at all. But if you can tolerate the risk, I suggest that you give JD a try. And it's just, if we're going to get rich, let's get rich together, right? If we're going to go bust, let's go bust together. But again, this is not financial advice. Do your own due diligence and make a move. All right. Hopefully you enjoyed this. Maybe you found this helpful. And with that said, mic drop.